Have you ever looked at a massive accounting spreadsheet and thought to yourself, okay, this isn't just math, this is actually a lie detector? Well, welcome to our explainer today. We're going to be digging into the extended trial balance. And look, we are absolutely not going to treat this as just some dry, boring 10-column worksheet. No way. We're going to look at it as the ultimate truth-telling mechanism of a business. Because honestly, within all those rows and columns lies the exact financial DNA of an organization. And as we'll see a bit later, the ethical soul of the actual people putting it together.
All right, let's dive into the roadmap really quick. We're going to start with the extended trial balance and mastering adjustments. Then we'll pivot over to the 5 ethical pillars, ethics and practice, and finally we'll wrap up with the very real cost of cooking the books.
Okay, part 1, the extended trial balance, the structure of truth.
So before we can talk about the art and the ethics of accounting, we really have to understand the rigid structure that organizes all this raw data into a story that actually makes sense. Think about the architecture of these 10 columns. It's literally a journey from left to right. We start with the unadjusted trial balance, the raw year-end balances before anyone even touches anything. Then we factor in the adjustments. These are those necessary tweaks for things like accruals or depreciation. Next, we combine those to get the adjusted trial balance, double-checking that our debits still perfectly match our credits. And finally, we split that data up. Revenue and expenses, they flow right into the income statement columns. Assets, liabilities, and equity, those flow straight into the balance sheet columns. It's a genuinely brilliant filtering mechanism.
Now here is where the magic actually happens. When you total up the income statement columns, they are not going to balance right away. The difference between your revenue credits and your expense debits, that's your net profit. Like in the source example we have here, it's a net profit of 4,700 rupees. So the really crucial point to understand is that this balancing figure is then transferred over to the balance sheet columns. Once you add that profit to the equity side, boom, your final balance sheet columns balance perfectly. It's kind of like mathematical poetry.
Moving on to part 2, mastering accounting adjustments, the mechanics.
Look, the unadjusted trial balance is rarely perfect right out of the gate. Accountants have to step in to reflect economic reality. Let's walk through the logical flow of a standard adjustment using 4 basic steps. Let's take closing inventory as an example. At year-end, you do a physical count, right? And let's say you find you have 12,000 rupees sitting in inventory. Well, to adjust this, you debit the balance sheet to record the asset and you credit the income statement to reduce the cost of sales. Then you calculate the new adjusted totals and simply transfer them to their respective final columns. It's just a really precise, step-by-step injection of reality straight into the ledger.
But as you can probably guess, not all adjustments are quite that simple. Take the disposal of a non-current asset, for instance. If you sell some equipment, you can't just casually write down sold for 2,500. No, you have to entirely remove the asset's original cost, let's say 10,000, with a credit. You also have to remove its accumulated depreciation, say 7,000, with a debit. Then you record the 2,500 cash you received as a debit. And finally, that balancing figure of 500, that's recognized as a loss on disposal. So you have one real-world event, but it takes 4 distinct lines of adjustment to capture it correctly.
And hey, adjustments aren't just for routine updates either. They are absolutely essential for fixing human errors that we discover after pulling those initial totals. For example, imagine a 3,000 rupee equipment purchase was just accidentally logged as a routine repairs expense. It happens. The adjustment column is exactly where you correct that. You credit the repairs expense to zero it out, and you debit the equipment asset account so you can properly capitalize it.
So that brings us to a massive thematic pivot in our explainer today. You've done the math, the debits equal the credits, the columns balance flawlessly. But is the financial statement actually telling the truth? Because here is the chilling reality we have to face. A spreadsheet can catch a math error, for sure, but it absolutely cannot catch a lie.
Which leads us to part 3, the 5 ethical pillars, the soul of accounting. Now, these pillars are based on the internationally accepted IESBA ethical framework. And pillar number 1 is integrity. This means being completely straightforward and truthful. No intentional omissions, no manipulation. It sounds obvious, right? But without integrity, those pristine accounting records we just walked through, they become really dangerous instruments of deception. If you deliberately omit a liability, your beautifully balanced spreadsheet is really nothing more than a highly structured fraud.
Then we have pillar number 2, objectivity. Look, accountants face immense pressure. We're talking pressure from management to artificially manipulate depreciation or maybe tweak provisions just to meet profit expectations or satisfy debt covenants. Objectivity requires making judgments completely free from that bias, free from conflicts of interest, and free from personal gain. You report the facts, not the narrative that management desperately wishes were true.
Pillar number 3 is professional competence and due care. You can be the most honest person in the world, but if you don't actually know what you're doing, you are still a massive risk. Just simple negligence, failing to maintain updated technical knowledge, or poorly applying accounting standards, all of that can cause massive material misstatements. Basically, ignorance is simply not an excuse when you are building the financial foundation of an entire business.
Okay, Pillar 4, confidentiality. This is huge. Accountants have access to literally everything: unreleased earnings, cash flows, top-secret strategic plans. Protecting this highly sensitive information is paramount. If an accountant were to prematurely share, say, unreleased quarterly results with outside investors, well, that's not just a breach of trust. That amounts to flat-out illegal insider dealing.
And finally, the 5th pillar is professional behavior. This just means complying with laws and avoiding actions that bring disrepute to the entire profession. Think about it. Colluding with management to backdate invoices or suppress liabilities, it completely destroys public trust. And at the end of the day, public trust is the only currency the accounting profession truly relies on.
All right, part 4, ethics in practice, rules of the road.
So how do all these abstract pillars actually govern daily reality? Well, it starts with the absolute baseline requirements for ethical record keeping. Records have to be complete, accurate, timely, and properly classified. But most importantly, there must be incredibly strict compliance with internal controls. Things like the segregation of duties or restricted system access. That's not just annoying red tape. Deliberately bypassing internal controls creates a perfect breeding ground for fraud and concealment.
Let's actually look at a direct comparison here. Ethical practice is recording actual, verified sales. Simple. Unethical practice is logging entirely fictitious revenue entries just to artificially inflate your profits right before a big earnings call. The crazy thing is, a financial statement might technically comply with all the formatting requirements, it might look perfectly fine on an extended trial balance, but if the underlying entries are fictitious, the entire document is just intentionally misleading.
Part 5. The cost of cooking the books, cascading consequences.
So what actually happens when we just throw these ethical standards out the window? Well, the consequences are devastating and they cascade fast. Down at the individual level, the accountant faces losing their license, a completely ruined reputation, and maybe even prison time. For the organization itself, misleading data leads to internal strategic failure, a total loss of investor confidence, massive lawsuits, and very often bankruptcy. But it doesn't even stop there. On a macroeconomic level, it causes a huge loss of public trust in capital markets. Honest firms end up underfunded, everyday employees lose their jobs, and entire pension funds can collapse. It is a massive social harm.
And this really illustrates the tragic irony of unethical accounting. Check out this dynamic. An unethical action like hiding your liabilities provides a short-term benefit, right? You get the illusion of better solvency. But the long-term consequence is completely inevitable: a loan default and a total catastrophic loss of creditor trust. Overriding internal controls might give you faster approvals today, sure, but it spawns a really weak governance culture that destroys the company tomorrow. That short-term illusion is always swallowed up by a long-term financial catastrophe.
Honestly, you can't talk about this without bringing up the ultimate cautionary tale, the Enron scandal. Enron's accounting fraud didn't just bankrupt a corporate titan. It completely destroyed Arthur Andersen, which at the time was literally one of the world's premier audit firms. It obliterated thousands of jobs, it wiped out life savings, and the fallout was so extraordinarily severe that it forced governments to create entirely new regulations, like the Sarbanes-Oxley Act, just to try and desperately rebuild public trust. I want to share this incredibly powerful quote from the source material with you all. Ethical behavior should be viewed not as an optional professional virtue, but as the essential foundation of reliable accounting and sustainable commerce. Honest accounting really isn't just about balancing numbers on a page. It is the fundamental language of global business trust. So next time you're staring down one of those extended trial balances, just remember that those debits and credits represent real-world actions, driven by actual human choices. And the biggest question you really have to ask yourself is this: will the numbers you report build the foundation of commerce, or will they architect its collapse? Thank you so much for joining me for this explainer today. Keep learning, keep questioning, and we will see you next time.